The US dollar extended its decline yesterday as soft retail sales data from the US reinforced signs that the American consumers may finally be losing altitude. December sales showed no growth at all on a monthly basis, while the annual figures slowed sharply, dragging the Atlanta Fed's GDP now estimate for the fourth quarter lower. So markets are increasingly leaning toward an earlier Federal Reserve easing this year, earlier than in June. The US 2-year yield has fallen to multi-year lows, thus pressuring the US dollar and fueling a rotation away from big technology towards smaller and non-technology pockets of the market. Meanwhile, AI investment remains a powerful growth engine for the US, but questions are emerging about leverage and valuations and the potential winners versus losers of these AI tools. Anyway, all eyes now turn to the belated US jobs report today, which could either reinforce this rotation theme or further weigh on sentiment. So welcome to Swissquote's Daily Market Talk. It's Wednesday, February 11th. I'm İpek Özkardeşkaya, and everything I will say in this video is based on my own opinion and analysis, and this is not financial advice.
This show is brought to you by Swissquote.
So the US dollar just got weaker yesterday after the US retail sales data pointed at no growth in December sales. Not at all on a monthly basis. The yearly figure retreated to 2.43% from around 3.6% printed a month earlier. And the latter pulled Atlanta Fed's GDP now forecast for the fourth quarter of last year to 3.7%. This figure was hovering above 5% early January. And there's more. The delinquency rate in the US rose to the highest level since the pandemic months for some groups there, very much in line with the waning consumer confidence, weakening jobs data, and people complaining about the cost of living crisis in the United States, a thing that the White House does not want to hear, but it may be happening. The US consumer spending may be finally weakening for real this time. And the latter is a big threat for an economy where consumer spending is the major pillar of economic growth. Now, the massive AI investment will certainly continue to do a part of the lifting, but these investments won't necessarily create jobs on a net basis, and they may not ease the cost of living overnight. So if that's the case, the two-speed growth in the US economy today will require the Federal Reserve's precious help to get better. And this is why we see the US 2-year yield that best captures the Fed expectations fall to 3.5-year low levels, and the US dollar weaken as a result of it. Softer yields and cheaper US dollar have a positive impact on equities, but with a nuance still. The softening Fed outlook reinforced the rotation trade and fuels appetite for smaller and non-technology companies than the big technology that ultimately benefit from a cheaper US dollar. But they are being severely questioned these days by investors about their ambitious AI investment plans that are increasingly being financed by debt. And that's a big deal, because one of the brightest spots of the big technology companies, one that made them immune to rate policies, for example, and global crisis, was their strong balance sheets and ample free cash flow in hand. But the past 3 years, AI investments ate into these free cash flow, and now they're obliged to seek financing by debt. Google just issued a $20 billion debt this week on top of a $17.5 billion issued last November. And it's not the only one. Meta issued $30 billion debt in October, Oracle a whooping $43 billion debt since last September, and Amazon some $15 billion debt. The problem is, so much debt changes the leverage and the risk of these companies, and that should pull their valuations lower. Now, obviously, a softer interest rate environment would help, but for now, investors are too busy worrying about valuations. The S&P 500 was actually offered yesterday near a record high level, while its equal weighted version hit a fresh all-time high level. The Dow Jones Industrial Index and the Middle Cap Index in the US also extended their gains to fresh record high levels yesterday on the back of dovish Fed expectations. The small cap index looked more timid, however, probably somehow demoralized by the rapid deterioration that we see in the Main Street data. So today, the US will be revealing its latest jobs data that was originally due last Friday but was postponed to today due to a partial US government shutdown. The expectations are weak. The US economy is expected to have added around 66,000 non-farm jobs in January for a slowing wages growth to 3.6% on a yearly basis, and the unemployment rate is seen steady near the 4.4% level. But if we dig deeper, the unemployment rate for workers between 16 and 24 years old stood past 10% in December. So the struggle in the US jobs market is real, and a set of soft data will likely reinforce the dovish Fed expectations, further push the US short-term yields and the US dollar lower, and give support to the rotation trade. A stronger than expected data, however, may ease the call for earlier Fed cuts, but won't change the idea that a part of the US economy, the part excluding technology, is headed toward the wrong direction. The Main Street needs the Fed's help, and inflation may be actually tempering due to the softening consumer spending to help the Fed help the US economy. Right now, activity on Fed funds futures started tilting for a possible rate cut by April instead of June. The expectation that the Fed could deliver a rate cut in June is now approaching the 80% level, up from around 50-50 earlier this year. And the probability of an April rate cut from the Federal Reserve now stands at 42%, getting closer to a coin toss. In the FX, the Japanese yen is unquestionably one of the biggest beneficiaries of the softer US dollar. The dollar yen has just slipped below the 153 mark this morning in Japan in a very, very unexpected move indeed after Sanae Takaichi in Japan won weekend snap election. The next key support here to watch is the 152.18 mark, which is the major 38.2% Fibonacci retracement on last April to January rebound. Clearing this level will mark the end of the Japanese yen's almost a year-long debasement against the US dollar. Voila. Elsewhere, the technology space was again torn between great and scary news yesterday. TSMC continues to extend gains toward uncharted territory after announcing a 37% jump in its revenue this January. The revenue was also boosted by the fact that last year's Chinese New Year fell on a January and this year it falls on February, but the numbers still look consistent with their 30% growth target for this year. Asian technology stocks extended gains as well to fresh all-time high levels on hope that the Federal Reserve and the People's Bank of China will continue to give support to their respective economies, because in China it's not sunny either. The latest inflation data came in softer than expected, again warning that the fight against low inflation in China is not over just yet. And I'm not even talking about the property crisis that's still ongoing and the aging Chinese population. Apparently there are now bars and clubs in Shanghai where singles go to party and get married on the way. This is how the situation is dramatic in China. But anyway, back to technology. TSMC and memory chip buddies are obviously happy about the latest TSMC numbers, but the news don't necessarily enchant software stocks that have been hit by a fresh wave of weakness on news that an AI startup called Altruist this time released a new tool to help finance advisors personalize their investment and wealth management strategies for their clients. Charles Schwab, which had been gently grinding higher, suddenly tripped and fell more than 7% yesterday. The news obviously interrupted a rebound in software stocks as well that were battered by similar news last week coming from Anthropic, remember? But the divergence between the AI enablers and the software stocks today is so striking that the software dip starts looking interesting for those who think that the AI tools won't replace all lawyers and all client advisors on face of this earth by tomorrow. But what do I know? So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.